Welcome to the deep dive. Today, we are opening up this really dense stack of options trading notes, financial glossaries, and some pretty intense real world case studies.
Yeah, and the mission here is to basically build a master class on strike selection, volatility,
Mm.
and, well, the hidden mechanics of pricing.
Right, because we want to take all these raw data points and extract the practical step by step logic you absolutely need to understand before putting any of your own capital at risk.
Exactly. You really have to know what's happening under the hood.
So to start, I want you to imagine for a second that you are eyeing Netflix. And this is right before their quarterly earnings report.
Oh, a classic setup.
It is. So the stock is sitting right at $190 a share. And you've analyzed the trends, you've read the reports, and you have this incredibly high conviction that they are going to just completely crush their estimate.
Yeah, sure, the stock is going to pop.
Exactly.
Yeah.
So you buy the $210 out of the money call option, and you pay an $8 premium for it. You lock it in.
Okay, an $8 premium.
Right. And then the earnings come out, and you were absolutely right. I mean, Netflix crushes it. The stock jumps 5% immediately, right up to $200 a share.
So you perfectly guessed the direction.
Perfectly. But then the market opens, you check your account, and that $8 call you bought, it has plummeted to $4.
Ouch. Yeah.
You just lost half your money while guessing the direction of the stock perfectly. So, okay, let's unpack this. How do you predict the future, get the direction right, and still lose 50% of your investment?
I mean, it is the ultimate reality check in trading, isn't it? You get the absolute hardest part, right? The directional movement, but the actual mechanics of the instrument you are using completely betray your thesis.
It just feels so wrong when it happens to you.
It does. But to understand why that specific Netflix strategy exploded in your face, we first have to kind of perform an autopsy on what that $8 premium was actually buying in the first place.
Because it's not like buying stock. When you just buy 100 shares of a stock, the pricing is linear.
Right, stock goes up 5%, your equity goes up 5%.
Yeah, but the notes here make it very clear that an option premium is not just one monolithic price. It's actually composed of two entirely separate variables operating at the exact same time, right? Intrinsic value and extrinsic value.
And those two components, they literally dictate the entire life cycle of your trade. So, intrinsic value, that's the immediate, tangible exercise value of the option if you were forced to cash it in right this very second.
The meat of the sandwich.
Exactly. For a call option, that is just the current stock price minus your strike price. If the stock is trading higher than your strike, the option has intrinsic value. It is in the money.
So if we look at the Apple case study from the sources, this becomes really clear. Let's say Apple is currently trading at $180 a share.
Yeah.
If you look at the $170 call option, the total premium you have to pay is $14. Because the stock is $10 above your strike price, 10 of those $14 are intrinsic value. It's real equity.
Which means that leaves $4 completely unaccounted for by the current stock price.
Right.
And that remaining $4, that is the extrinsic value. You can really think of extrinsic value as the premium you are paying for time and volatility. It's the sizzle.
The hope.
The hope, exactly. It is the cost of the probability that the option might become significantly more valuable before it expires.
So if you are looking at an at-the-money option, let's say that $180 Apple call, while the stock is exactly at $180, the premium is $6.50.
And there's zero intrinsic value there.
Right. If you exercise it instantly, you gain absolutely nothing. That entire $6.50 is pure extrinsic value. You are paying purely for probability.
Which, fundamentally shifts the math on your risk. When you buy an option, you aren't just betting on the stock moving. You're betting on the stock moving fast enough and far enough to overcome that extrinsic premium you just handed over to the market maker.
I want to walk through the actual math on that just for the listener because the break-even calculation is where I think a lot of theses fall apart.
Yeah, it's crucial.
Wait, if I pay $14 for that in-the-money $170 Apple call, my actual break-even isn't $180.
No, it's not.
It is the strike price plus the premium. So 170 plus 14 means my actual break-even at expiration is $184.
You have to clear that hurdle just to get your money back. Like, if Apple closes at $183 on expiration Friday, the option is still technically in the money.
Right, it's worth $13.
But because you paid $14 up front, you take a net loss on the trade, despite the stock being $13 higher than your strike.
Wow. So every day that the stock just chops sideways or, doesn't move aggressively enough toward that $184 target, you are bleeding out that extrinsic value.
Exactly.
This makes me want to unify the metaphors here to really visualize what is happening because the sources break down the Greeks that govern all this pricing. So if the underlying stock price is the engine of a car, delta is your speedometer.
That is a highly functional way to look at it. Delta measures how much the options price is expected to change for every $1 move in the underlying stock.
It's the speed.
Right, it's the speed at which your option accumulates value. So a delta of 0.50 means your option gains 50 cents for every dollar the stock goes up.
And practically, traders use delta as a probability metric too, right? Like a deep in the money option might have a 0.85 delta.
Which means the market is pricing in an 85% probability that it will expire in the money. It's moving almost at the exact same speed as the underlying stock.
But if delta is your current speed, gamma is the accelerator pedal.
Yeah, gamma measures the rate of change of your delta. When you step on the accelerator, your speed doesn't just instantly jump, it climbs.
Right, it ramps up.
Gamma dictates how aggressively your delta increases as the stock moves in your favor.
But the trade-off is the aerodynamic drag that is constantly slowing the car down, which brings us to theta.
Theta is the time decay. It is the friction literally eating away at your extrinsic value every single day, completely, regardless of what the stock price does.
And that friction accelerates the closer you get to expiration. But to fully explain the Netflix disaster we open with, we have to look at the road conditions themselves.
Weather.
The weather, exactly. That is implied volatility, or 5E. It's the market's expectation of how violently that stock is going to swing in the future.
And how do you visualize that one?
Well, the analogy I always come back to for 5E is hurricane insurance.
Right.
If it's a calm, sunny day in Florida, buying hurricane insurance is incredibly cheap because the implied risk is low.
Almost zero.
But if there's a massive storm sitting off the coast tracking straight toward the state, the premium on that exact same insurance policy skyrockets. Everyone knows a massive binary event is about to hit.
Which is exactly what an earnings report is. It's a scheduled storm.
Yes.
So before that Netflix earnings call, the implied volatility on those options was sitting at an incredibly inflated 120%. The market was actively bracing for a massive violent swing in the stock price.
So when you paid $8 for that out-of-the-money $210 call, you were paying for peak hurricane insurance. You were buying pure extrinsic value at the absolute height of the panic.
And then the earnings report dropped.
The storm made landfall.
And immediately dissipated. Netflix beat the estimates, the stock went up to $200, but the uncertainty was completely removed from the market.
Because the event was over.
Right. So the implied volatility instantly collapsed from 120% down to 45%.
Oh man, the Ivy crush.
The crush. That extrinsic value you paid $8 for was violently deflated. The stock simply didn't move high enough to gain any intrinsic value to offset that massive loss in implied volatility.
So the pricing mechanics worked exactly as they were designed to work. You just bought the wrong side of the equation.
Precisely.
And here's where it gets really interesting, because this brings up a massive tactical pivot outlined in the sources. If we know that a high IV environment, specifically when the IV rank is above 50, if we know that inflates the premium to irrational levels, then buying them is structurally a bad idea.
It's disadvantageous, yeah. The mathematically superior strategy is actually to be the one selling the options.
You step in as the insurance company.
Exactly. Instead of buying the overpriced hurricane insurance right before the storm, you sell it to the panicked crowd. You collect that inflated premium up front.
And when the IV crush inevitably happens after the event,
The value of the option you sold plummets, which allows you to buy it back for pennies or just let it expire, completely worthless. You are basically utilizing the crush as a tailwind rather than a headwind.
So, okay, if betting on out-of-the-money calls right before an IV crush is a guaranteed way to bleed capital, how do we, as traders, systematically match our strike selection to our time horizon?
That is the big question.
Let's look at the moneyness spectrum in the sources, starting with the long-term approach. The Microsoft LeapC study is fascinating because it completely sidesteps the friction of time decay we just discussed.
Yeah, so LeapPosts are long-term equity anticipation securities. They're essentially options with expirations a year or more out.
Okay.
In the Microsoft case study, the stock was trading at $250. Now, instead of buying a cheap out-of-the-money hope ticket, the trader bought a deep-in-the-money January leap. They bought the $200 strike call, and they paid $65 for it.
Wait, hold on. If they have over a year for the stock to run, why tie up $65 a share on a deep-in-the-money strike? I mean, wouldn't an out-of-the-money call offer a much higher percentage return if Microsoft really takes off?
It is such a common trap to think that way. But buying out of the money over that long of a time frame exposes you to immense probability risk and theta decay.
Right.
By buying the $200 strike, when the stock is already at $250, $50 of that $65 premium is pure intrinsic value. You are buying a delta of 0.85.
So the speedometer is practically matched to the stock itself.
Exactly.
Yeah.
And because the extrinsic value is so incredibly low, your theta drag is virtually non-existent. This is a classic stock replacement strategy.
It moves almost one-to-one with the underlying stock.
Yes, but look at the capital efficiency. Buying 100 shares of Microsoft at $250 requires $25,000 of capital.
Okay.
Buying one deep-the-money ALA contract requires only $6,500. You get the exact same upside exposure for a fraction of the capital risk.
Wow. And the outcome in the case study really proves the structural advantage there.
Yeah.
Because Microsoft rose 52% over that period, up to $380.
Right.
But because of the leverage, and really the lack of time decay, the LP option gained 170%. You captured massive upside without the stress of watching your extrinsic value evaporate every day.
However, you have to invert that logic entirely when you look at short-term trading.
Obviously.
If you are doing a swing trade on Apple and you only have a time frame of, say, 3 or 4 days, buying a deep-in-the-money A is terribly inefficient. It just won't give you the acceleration you need to profit off a tiny move in the stock.
Right. For short-term day trades, the sources point directly to at-the-money options or maybe just one strike out of the money. And this goes back to our car metaphor and the accelerator pedal gamma.
Right, gamma. At-the-money options have the highest gamma of any strike on the entire chain.
Meaning they are the most sensitive to sudden price movements.
Exactly. If the stock makes an explosive move in your direction, the high gamma ensures your delta increases violently. Your speedometer instantly cranks up.
You want the accelerator matched to the floor because you don't have the luxury of time.
You don't.
But if at-the-money gives you high acceleration, we definitely have to talk about the extreme end of the short-term spectrum, the deep out-of-the-money lottery tickets.
Oh, the GameStop chaos.
Yes. The GameStop chaos in the notes is the ultimate cautionary tale of how the Greeks can literally turn lethal.
GameStop perfectly illustrates the brutal reality of Vega and Theta. So when the stock was trading around $40, retail traders started just flooding into the $60, $80, and $100 strike calls expiring that exact same week.
And because they were so far out of the money with almost no time left, their delta was near zero. They were trading for pennies.
Right. But then the underlying engine caught fire. The short squeeze happened.
It did.
The stock price accelerated so violently that the market makers were caught totally off guard. But it wasn't just the stock price moving. The implied volatility exploded from a baseline of 100% to over 600%.
And that massive spike in IV turned those 50-cent options into $100 contracts. I mean, it is the allure of the lottery ticket playing out in real time.
It is. But the structural lesson from the sources isn't actually about the winners. It's about the people who showed up late. The traders who saw GameStop at $300 and decided to buy the $500 call.
Oh, man, because at that point, you are buying into a 600% implied volatility environment. You are paying astronomical premiums for purely extrinsic hope.
And when the buying pressure finally stalled, the momentum died. The stock didn't even have to crash for the options to become worthless.
Really?
Just the mere fact that the stock stopped rocketing upward caused the implied volatility to collapse.
Yeah.
Those late buyers were hit by a catastrophic IV crush, combined with the fact that their short-term options were bleeding theta by the hour.
Their positions went to zero almost instantly.
Almost instantly. If you are playing deep out-of-the-money strikes, you require an enormous violent move in a tiny, tiny window of time. If you get anything less than that, the mechanics of the option will just bleed you dry.
So if betting on explosive short-term upside is basically a mathematical gamble with terrible odds, how do the largest institutions in the market price the exact opposite scenario, like a sudden violent crash?
That's where things get structural.
Because the sources reveal that volatility isn't just about time and earnings events, right? It fundamentally changes depending on the ticker and the direction you were betting.
Yeah, this introduces the concept of volatility skew. Let's look at the data provided on the SPY ETF, which obviously tracks the S&P 500. The pricing dynamics here really expose a massive psychological bias in the market.
The numbers in the SPY example are honestly incredibly stark. So a put option that is 10% out of the money has an implied volatility of 18%.
Right.
But the at-the-money option has an IV of 14%. And a call option that is 10% out of the money, which is the exact same mathematical distance away from the current stock price as the put, has an IV of only 12%.
The market is charging a massive premium for downside protection compared to upside speculation. The put is structurally more expensive than the call, despite being equidistant from the underlying price.
So what does this all mean for the listener's wallet? Why is that disparity so wide? If the stock has an equal chance of moving 10% up or 10% down, why does the math completely break down on the put side?
It comes down to one thing: institutional fear. The largest players in the market hold multi-billion-dollar long portfolios of equities. They are systematically terrified of a sudden, violent market crash wiping out their wealth overnight.
So to hedge that risk,
They are constantly, relentlessly buying out-of-the-money put options as portfolio insurance.
it's the fire extinguisher versus the lottery ticket.
Exactly.
People will irrationally overpay for a fire extinguisher the second they smell smoke because, the consequence of your house burning down is catastrophic. But they won't pay nearly as much for a lottery ticket because missing out on a potential gain isn't going to ruin them.
And that persistent structural demand for downside insurance means market makers take on massive tail risk when they sell those puts. To compensate for taking on that crash risk, they inflate the implied volatility on the put side.
The market is structurally biased to expect that stocks take the stairs up, but the elevator down.
That's the perfect way to phrase it.
And understanding that skew gives you a really profound edge. It means that, as a baseline, out-of-the-money puts are historically overpriced due to institutional paranoia, which completely validates the strategy of selling SPY puts during a VIX spike.
Yeah.
Because when the market panics, that 18% IV on the put side might spike to 40%. You step in, act as the insurance company, and sell that wildly overpriced fire extinguisher to a terrified market.
You exploit the mathematical skew that is created entirely by human emotion.
So, man, we've broken down the structural difference between intrinsic equity and extrinsic hope. We've mapped the Greeks using the engine, the speedometer, the accelerator, and the drag.
We've covered a lot.
We've navigated the devastation of the IV crush, matched time horizons with capital efficiency, and decoded the psychological fear skew. How do we distill all of this into a hard pre-trade checklist for you before you put capital on the line?
Well, every single trade needs to pass through a disciplined filter. Number one, explicitly define your thesis. What is the directional target? What is your exact time frame? And what is your conviction level?
Okay, got it.
Number two, check the implied volatility rank. Is 4 fee historically high or low for this specific ticker? That single metric dictates whether you should be buying options to capture cheap premium or selling options to exploit inflated panic.
Right. And number three, calculate your absolute max loss risk budget. Run that break-even math we talked about. Understand exactly what price the stock has to hit just for you to get your premium back, and never risk a percentage of your account that you can't survive losing entirely to a sudden IV crush.
If we synthesize all the glossaries, the math, and the case studies down to one unbreakable rule, it is this: always match your strike aggression to the time and volatility you have available.
Always match your strike aggression to the time and volatility you have available. If you don't have time, you cannot afford the friction of deep out-of-the-money strikes. It really closes the loop on that opening Netflix scenario.
It does.
You never want to be the trader paying for pure extrinsic hope right before a scheduled storm passes. You want to understand the invisible mechanics operating under the hood, dictating the real price of the asset.
Because relying on direction alone is just gambling.
Yeah.
Understanding the mechanics is what makes it trading.
Which leaves us with a final provocative thought for you to mull over. We just broke down how the market systematically overprices out of the money puts due to a chronic, deeply human fear of crashes.
Right. The skew.
But as algorithmic trading and AI-driven market makers continue to take over the vast majority of daily trading volume, what happens to that volatility skew? If algorithms don't feel fear and they only calculate probability, will that structural psychological advantage eventually be priced entirely out of existence?
That's a great question.
Or will the AI simply learn that replicating human panic is the most profitable strategy of all? Think about that next time you look at the pricing on an options chain. Thanks for joining us on this deep dive.